Hi everyone, this is Demel Gonzalez of Heartwood Financial Services. Welcome to the July edition of the Market Update. So exciting news, we are repackaging these videos. I felt like they were getting a little bit long, so what we're trying to do is split them up a little bit. What you're going to hear today is the market outlook with the update. And it's going to be a little shorter than the videos before because they don't have the educational and inspirational piece. Those pieces are going to be coming out in subsequent weeks over the next several weeks. So let me know what you think. Hopefully going to make it a little bit more bite-sized than before. Feel free to subscribe below, that's new, and comment if you like. And again, feel free to share with your friends and family. Appreciate it. All right, why don't we get kick-started here with the asset class returns. Let's start off with the large cap stocks. As you can see here, the S&P was up 2.38%. Pretty impressive. I thought the market was going to maybe have a little bit of a soft patch here over the next over the summer, including maybe another month or so, but it looks like it's actually held up pretty well. So up 2.38 for the S&P, although you are starting to see some soft patches in the small caps. Small caps were actually down basically the same amount. Large cap was up about 2.39. Still strong year-to-date numbers for small cap, up over 20%. But the real winner here really for the last several months has been real estate, up 4.64% again on real estate, up almost 29, actually a little over 29% year-to-date for real estate. So really strong showing there. Inflation fears and economic recovery really good for especially commercial real estate. So you're seeing that there. Developed international and emerging market international had a pretty lousy month, especially emerging markets, as you can see here. So developed only up 0.4%. Still up double digits for the year, but not as good as the U.S. markets. A lot of that is they've been hit with COVID. They've been hit with the Delta variants. They're still, they're a little bit ahead of us with some of these Delta variants. So maybe now they're going to start coming out of the woods. We'll see. That's something I'm closely monitoring. And the dollar actually went down a little bit. So you would have thought this would have helped international, but it didn't. That's just how lousy of a month international had. Emerging markets especially. The big story there was China. They're really cracking down on their tech companies, all different types of companies really, financials as well, but recently it was the tech companies. And there's a lot of tech companies in China that affect the emerging markets. So that's what you're seeing there. Fixed income, the high quality fixed income was actually pretty good for bonds. Almost 1% up about 0.9. The high yield bonds, which are the lower quality bonds, actually had a decent month as well, up 0.72. Doing a little better year to date than the higher quality bonds. But you can see here it was kind of a risk off type month, except for the S&P 500. A lot of that was because the tech stocks here in the U.S. did really, really good. And interest rates stayed kind of level. So when interest rates stay kind of level, the bonds do well, and those tech stocks tend to do pretty well, which is really what dominates the S&P 500. And then the last thing is gold. Gold actually finally came back up a little bit. The dollar was weak. Interest rates didn't go up a lot. So that helped gold, which is why it was up 3.5%. But still pretty negative for the 1 year, or for the year to date. So that's the asset class returns for July. So another effect of the variant is what's happening to inflation. Now, quick update, as you can see here on this chart of the CPI, you can see how inflation has been going up a little bit. In fact, the last CPI report was up 5.4%. That's the highest it's been in a long, long time. And this is probably the number one thing I've been hearing about from my clients concerned about inflation. I'm still in the camp that inflation is not going to be as bad as it was in the 70s. What we're seeing is bad. but nowhere near that, and probably not going to last quite as long as that. As things start getting back to normal after COVID, inflation, I believe, is going to start going down. And so the reason I bring this up in my effects of the variant is because the variant is essentially just slowing down for things getting back to normal. And so that means it's going to slow down the effects of inflation getting back to normal, to the lower levels that we've been used to, more in the 2 to 3% range. Think about it. If people aren't going back to work because there's not the demand because the variant has slowed the economy down a little bit, or just scared because they don't want to get sick, that's going to slow down this process of things getting back to normal, including those supply chains and everything else that's been part of the inflation story. So unfortunately, this is going to delay things getting back to normal with inflation as well. Leading indicators strong, but slowing. And so I don't know if you remember seeing this chart before, but this top right quadrant is when things are going great, things are growing, we're in a great place, expansion. This left side is when things start to decline. Now they still may be good, but they're starting to decline. This is when things are declining and getting really bad. So we're definitely not there yet, but you can see there's a lot of stuff on this chart. The main thing I want you to focus on is this little red dot. This shows the average of where all those leading indicators fall, and it's just left of the expansion quadrant line for the first time. And so what we're starting to see is things are still good, but they're starting to slow down a little bit, and this is showing all those leading indicators. Now, again, my thought is that this might be temporary. Maybe this will bounce back. We'll have to see. I'm going to be monitoring that carefully, but we're right at that cusp where maybe things are going to slow down, and they're going to keep slowing down. And I think a lot of that has to do with the variant. Okay, so for the outlook, this is the part where we try to get the crystal ball out and see what's coming around the corner. Of course, it's not a perfect science, but the title for my outlook is it a speed bump or a U-turn? Well, if you've been listening for the last few minutes, you kind of know where I'm going here, but I'd like to explain to you why I think the way I think. And so first of all, the big thing would be the UK peak in the Delta variant. So I'm going to talk a little bit more about that. The sentiment is really starting to get pretty negative, and usually when that happens, that's actually a contrarian indicator, meaning that things could start turning around, believe it or not. And then the infrastructure bill is starting to look like it could be another stimulus that's coming out, so that could be positive for the markets. And then I'll talk about what the investment implications are and what we're doing here at Heartwood. So let's get into it. So first of all, let's talk about the UK Delta variant. On the left, what you're seeing here is what's going on in the UK. Okay, I use the UK because it's a really good parallel to what's going on here in the US. They're really just, and if you really study this chart, you can pause it and look at it a little bit more carefully. You can see they're about a month or so ahead of us. And when you look at the variant, they've got this second spike, which is the Delta variant. And you can see that they're starting to come down already. They're already almost halfway back down from that peak. When you look at what's going on here in the US, we hit the peak in January. Around the same time the UK did, but they hit the Delta variant peak a lot sooner than we did. And so are we peaking already? Hard to know exactly. It might continue to get a little bit worse. These things are obviously way beyond my understanding. But as you can see, if we're anything, the parallel that you can bring with the UK, we're anything like them, is that things are going to probably be peaking within the month, or within a month. And so if that's the case, I think what we'll see is we'll start to see better numbers starting to come in for hiring. better numbers coming in from the economy as people start to travel more and go out and do, the normal things that they do. So I think this variant is really just a speed bump that's hitting the markets right now that could be hopefully going away here soon. Now, you heard me talk about sentiment being pretty negative. This is a little graphic here from the Fear and Greed Index. You can go to their website. It's a pretty straightforward thing to find. But the Fear and Greed Index is, to me, a contrarian indicator. As I've looked at it in the past, when it's really, really high, that's usually a sign that maybe things are a little too good and they're getting ready to drop. But when they get really bad, like right now we're in the fear zone at about a 23, that's usually a sign that a lot of people are scared, and when that happens, usually the market is getting close to turning around. And it doesn't always happen, but it is a good indicator for things to start turning around soon. We'll see. And then the third piece on the outlook was the infrastructure bill looking hopeful. I don't know how closely you've been monitoring the Senate and what's going on there with the infrastructure bill. It does look like it's getting bipartisan support, which is amazing that they're getting any kind of bipartisan support in the Senate nowadays, but it does look that way. And it doesn't look like it's going to be quite as big as the Democrats were initially saying with the $3.5 trillion. It's probably looking like it's going to be closer to $1 trillion, maybe a little less. And at this point, doesn't appear to be any tax hikes. So this is kind of the sweet spot, I think, for the market. At least no tax hikes right now, and more stimulus money that's going to be going out to build roads and bridges, ports and things like that. So this could be another little stimulus for the market, something that the economy, or the stock market, I should say, will start to price in as it gets closer. Now, they still have to pass the House, and there's all kinds of things that could still go wrong, but it's at least a hopeful sign as a new catalyst for down the road. And for the fourth and last piece are the investment implications and what we're doing here at Heartwood. Well, first of all, with this being more of a speed bump rather than a U-turn, we're not going to abandon the ideas that we've been talking about for the past few months about focusing on more of the cyclical stocks, those value-oriented stocks, smaller cap stocks, and the international type stocks. So I'm still continuing to favor those areas a little bit, still keeping some of the tech and growth because, the markets can still have another variant and there's still a lot of curveballs out there that could be thrown. But I am still overall optimistic. Right now in the short term, I'm a little cautious because of the variant. It may continue a little longer than I suspect, and there could be other variants. And frankly, the market's a little high. So it's an interesting, delicate little balance that we got to do here for the next few months. But again, for the rest of the year, still pretty optimistic about things. And so we'll continue to have that weighting and favoring some of those value stocks. I hope you guys found this helpful and interesting. As always, call me, email me if you have any questions. Subscribe for the channel. This is kind of new. Learning how to use YouTube here. So subscribe, share with your friends, and thank you very much. Till we meet again.